Hey, everybody, welcome back to the Risk and Roll podcast, a production with some of my favorite friends in the compliance and management of data and mortgage and stories of bold and abound. We're missing Ray Snitcheville today because he, had to travel with family. Crazy guy. Can't believe that. What a man.
Yeah.
But still, the lesson's clear. Don't miss an episode. Look what happens if you don't show up.
Yeah. Yeah.
We are going to cover kind of an interesting topic today that I'm finding on the production side. Loan officers were always like, oh, so you're going to have a new credit score, a new credit modeling, which, I mean, the way was paved back in 2018 with the GRCPA passing for new credit models, and then nobody actually did anything with it until, well, it's 2026. So 8 years later, and a full national COVID crisis, a world COVID crisis later, now we have a different option. But guess what? I don't know that it's actually caused much to happen. So we're going to lean in with Greg, Oliven Polygon Research, because he's got some interesting stats that we can start responding to. What do you think?
Yeah, absolutely. Thanks, Nathan. Yeah, I think Fannie and Freddie are starting to press the gas a little bit on making things happen. We've got a few different initiatives up in the air. I'll recap them in a moment, but we've been watching for the last several months in the MBS data feeds where we key in on both originations as well as performance of their portfolios. We've been seeing, saw some new fields appear, VantageScore 4 and related fields, but almost no data. Data's finally started to trickle in. The reason it's only trickling is that there's only a handful of lenders that have been approved and are working with the GSE to start using this model. So everything's slow and conservative, but toward that end, the big development this month is that there was a big data publication by Fannie and Freddie. It was clearly coordinated by FHFA. And what it is it's not sort of the turning on of the spigot that I just described. That's still moving slowly, but it's historical data. And what it really is counterfactual data. They said, what would it look like for 50 million plus loans if we had been using both models, both not just VantageScore 4, but also I should say FICO 10T over the last several years from 2013 through 2025. And that's what they published, a big counterfactual data set at the loan level. So it's really fascinating. They did this across multiple data sets. I think the context that this falls into is that there are sort of three parallel modernization tracks afoot. One is the going from the 3 poles to the 2 poles, try-merge to bi-merge. The other is sort of the methodology by which they take however many you're pulling across however many applicants there are, how do you combine those scores? And that's the whole middle, lower, lowest versus average. That's also in progress. Neither of those is up and running yet, but kind of in progress. And then in parallel with that, they're looking to modernize and allow diversity and choice among the credit scoring engines themselves. This is where we're moving from classic FICO, which is actually a family of models, which kind of took a snapshot of you at a moment in time, to more trending-oriented models. In fact, that's the T in 10T is trending, or that's what that implies. So we're looking at VantageScore 4, which gets a lot of the attention, but also FICO has a new entrant there as well, 10T. So all of that's in progress. And I do have some takeaways, but let me kind of pause there. That's the context in which this big data drop happened.
Yeah, I think it's interesting that the exercise hadn't already been run, right? I think there's going to be, potential opportunities or widening of opportunities of borrower pools by having these options. But there also could be potential impacts on approval odds for, thin files, right? And so I would have expected, if we were considering, different models, the data from the past is a great predictor of what the future could be. So let's use the data that we already have to model. I know there's things that I just go, this is common sense, but we all know common sense isn't so common anymore. So great that they're doing it now and that it's coming out. So I'm really interested to see what they've come up with, Greg.
Yeah, absolutely. Well, let's set the stage.
Before we go through, I'm gonna say one thing. I'm working with a borrower in the state of Iowa as an assistant on this file, and I've been talking to this guy for a couple of years. And in fact, it took so long to get a loan done. I actually dropped my Iowa license, and then he came back. And one of the things we talked about, Greg, which is interesting in this concept, is that he had no credit score. He had no credit file. He hated credit. He did not want to be on a list anywhere.
Mm.
And so one of the things we had to overcome was like, hey, you have to have something. So let's start on the process. And he did not want to open a card. He ended up opening, I think, 2 little cards. And he went through and self-elected and self-reported trade lines, right? Cell phone bills and electricity and stuff. And got a score from 2 of the 3. But this whole change happened. I thought, okay, great. Actually, this should alleviate some of the difficulties that we're having here, because we're starting to show life and structure and everything, and it should alleviate the cost. In the production side, we were told, hey, new scoring models, guess what? It'll help drop the cost of pulling credit reports to the consumer or to the company, however you're paying for it. And I'm not seeing that. In fact, I'm actually seeing a negative move right now. It's the strangest thing to me. It doesn't make sense. It's like, oh, so what is it? Rising tides rise all boats, and hopefully, they would go the other way and things would actually get a little cheaper. No, the competition seemed to say, oh, Vantage is cheaper already. Okay, we'll just make it as expensive as the other one, and bumped it up the other way, which was so weird. So I'm interested in the data sets. But before we go there, Bob, you got any thoughts on that before we look at Greg's data report?
I look at it from a risk perspective. So you've got a guy who doesn't want to play the game. He doesn't want to be in the system. Frankly, I don't ever remember expressly giving 3 different companies access to everything about my life. I don't much like the game either. But when the Bank Secrecy Act was passed in 1970, the state of California sued federal government saying, too invasive, we're not playing, you can't check who's putting money into our banks. And the Supreme Court upheld the BSA and told California, nah, if you're going to play the game, we get to look at your accounts. You don't have to put your money in a bank, but if you put it there, we get to track it if you're doing bad things with your money. This kind of strikes me the same way. Your borrower is saying, I don't want to play. So what's the effect of that? If we're not going to create any kind of way for that person to be a homeowner at all, that's one way to go. And say, no, if you want to play, you gotta do this. That's the position the Supreme Court took with the state of California 56 years ago. So I look at it and I say, how do I feel about lending your friend money? Do I feel like this is the kind of guy who might skip out on me and not return my phone calls because he really is an off the grid guy? I don't know. I mean, how do you feel about that? Does working with somebody who is, I'll just call him non-compliant, and I'm not trying to be insulting with that term. Let's just say a free spirit. Your friend is a free spirit. Do you feel okay? Do you feel the same about lending that person money? What I mean, is that what
it's
we're
so
talking
different.
about?
That's what the scores were identified to do, is to help modernize, but also help anonymize the process and the independency. Because before that, what you're talking about, even fair lending in ECOA, was the fact that I would walk into a store and they would get to know me after a few transactions, and I would get issued credit from them. And my credit file was full of, hey, do you know Nathan who lives in Denison, Texas? That, yeah, I know that guy. I'd vouch for him. He'll pay his bill back. Right. This is the concept, was to overcome that. Whereas, having spent a couple of years with this individual, yeah, I believe he would pay his bill. I've actually seen his finances. I'm pretty deep into his information as a loan officer assistant on this file. And in seeing that, I could vouch for him, but it doesn't guarantee anything. But neither does a credit report. I've seen plenty of people with a great credit report decide not to pay their bills tomorrow. And that just, it happens. So anyway, I digress. Take us out there. What do you got, Greg, as far as the data sets that you're looking at?
Yeah, you were alluding to a couple of different things there, and it's interesting. One is the competitive nature of allowing different vendors to compete. Generally, that's a good thing. It's interesting to see the initial results that you're not seeing there, but hopefully that will improve over time. In that context, FICO is competing with itself because it's sort of superseding its old models with a new model alongside of VantageScore. So we'll see. But I think to the fellow you were working with, to that use case, I think that's exactly what this trending data is designed to pick up. It's not a snapshot from all the traditional sources, but it's trying to take into account different things. So we'll see. Hopefully that will help applicants like that and get a better read for both the applicant and for the underwriting department and the lender together. But a few stats. First, to set the stage, it's kind of interesting that HMDA carries, and okay, it's like the drinking game. Greg mentioned HMDA. HMDA carries the model that was used for underwriting loans, both for the applicant and for the co-applicant. And so I want to differentiate between one thing. We're talking with this data drop and what FHFA is looking at the GSEs. Of course, that's the core of the market. That's straight down the middle. But there are other loans that are being done, and lenders can decide whatever their standards are for whatever model they decide to use. So 10T, FICO 10T and VantageScore are, VantageScore 4, I should say, are already in use out there in the wild. And I'm just looking for the stats here. VantageScore 4, 1.7% of all loans originated in 2025 used it.
Okay.
And FICO 10T, 0.4%, less than 0.5%. Now, if you look at the GSEs, there's just a handful of loans that snuck through with those. Might be anomalous reporting. Basically, they're not accepting them yet. They're, like we were talking about, they're rolling this out slowly. So that's just to set the stage. There are a lot of models in use. The new ones are in use. Most of them are what's called classic FICO, which is a family of models. All right, so that sets the stage. But then when we look at this data that was dropped earlier this month, that's generated some buzz, this counterfactual data. What would have happened if we had both of these new scores across 53 million loans across over 12 years? And I've got a couple of headlines I'll call out, kind of stop and we can discuss them. I won't kind of throw them all out all at once, but first of all, on the competition front, sort of from the competing scores perspective, the correlation between the two scores is strong. It's about 0.86, but that kind of hides the detail. 47% of them differ by at least 20 points, and about 17% of them differ by at least 40 points. So overall, strong correlation. A lot of them are the same, but there's kind of a big range of differentiation because, again, this was at the loan level. So that's one initial headline. You might wonder, like, is one inflated over the other? It's a little bit of a wash. VantageScore 4 was higher in about almost 50% of the loans, but FICO is higher on 48% of the loans, basically the other half. They tie on 1.47. So there's a little bit of a mixture there. There's no one answer to that story. So that's on the competing score headline front. On the methodology that we talked about, this newer average versus middle, lower, lowest. So middle, lower, lowest is still the going concern. That's how people are doing it. That's what the GSEs are accepting today. But in this counterfactual data set, they put out some columns, some data points, again, at the loan level that would say, what if we did it the new way that we're contemplated? We've announced we're going to get there at some point. So switching only the calculation to average, holding everything else constant, raised FICO 10T by 8.18 points on average and VantageScore 4 by 6.14 on average. A little bit of a bump up, which kind of you would imagine that if you're not choosing the lowest, kind of driving for the most conservative number, a little bit more of a blended answer there. And yeah, some other statistics along those lines. So there's a lot more to dig into on the counterfactual there on that methodology, but maybe that's the least interesting, but it's there.
No, I don't think it's the least interesting, actually, Greg, because that increase could potentially put them in a different pricing bucket, right? So, the majority of pricing from an LLPA perspective is going to have credit score buckets. If that 8 points moves you into the next bucket, that means better pricing and potentially better leverage too, depending on, the type of deal that you're doing.
Yeah.
Better or worse pricing, because sometimes the higher score on the LTV is actually not a better pricing model. It's actually negatively priced a little bit.
Mm-hmm. And in private lending, for example, I mean, we do utilize scores. If on average there was an 8-point bump, from a credit score perspective, right? The higher the score, the better pricing. It might counterbalance, experience or other things that we use, from a leverage perspective, but all things being equal, if, they have the same, track record, 8 points difference, it absolutely could give them, potential leverage and price, in their favor.
Anecdotally, though, and this is in some of the loan officer groups that I'm in on socials and whatnot, we're discussing this because some people are coming in going, "Hey, what are you guys seeing?" Like they expected the top to be ripped off and the Vantage scores to be so much better and approvals to come through. And it's been exactly to your point, Greg. The data anecdotally has been about 50-50. Yeah, I pulled both. This was actually Vantage was worse than the other one. But what's funny is that a lot of first time home buyers, the ones that are coming in the first time, their Vantage score is always going to be just a little bit better because Vantage, it appears in my anecdotal mindset to take a heavier weight on revolving credit systems than it does on installment credit debts. And so it looks at it and goes, oh, well, you've paid the last 6 months of your payments well, therefore your score is a little bit better. It's a little bit kinder in such a way. So it appears anecdotally. I don't know. Somebody may be listening to this and understand exactly how the math works, and you're going to blow me out of the water with that. But from that position, I could see the Vantage helping somebody get past, but in nowhere. And to Dana's point, the pricing mechanisms alone are going to get modified as we get more and more data and hone in closer and closer on what the risk analysis truly is considered in the long-term rate on the secondary market when these things are securitized and put in the MBS.
The other thought about this is if lenders are pulling both, then they're having to make a determination about which one they're going to use. So are we getting some adverse selection, or, if they're always leaning into the worst one all the time, what is that going to say? If they're always selecting the better one,
Right.
what is that going to say? So I think there's a lot of risk
We
there.
know where this is going. Everybody's going to require 3 credit pools for 3 different creditors, and they'll take the middle of the middle of the middle. Like that's just how it's going to be.
Cut
Like
it in multiple ways.
I need to quickly come up with my own scoring mechanism so I can sell that in the market.
That's right. Go, Nathan. Well, the GSEs so far are holding that you have to use the same model across the different credit reporting agencies. So there's that to keep in mind. And I'll throw out one last category of stat then to kind of round out the this early read. I think ultimately, and this is the next round of analysis, is to play this out over time, and that's why they released a lot of historical data. And some folks have already started to publish some stats on this. What would have happened? Look at the loan's actual outcome that you can see in the portfolio data, and then compare that to the decisions that were made at underwriting. That's another way to think about this. And I think competition will drive the vendors to be as accurate as possible because they don't want to be associated with bad outcomes that their credit score suggested wouldn't happen. But in any case, the last category of stat for now up front is the bi-merge variation. Again, kind of the counterfactual range. And here we'll look at the 10T, FICO 10T. So the spread, and again, with bi-merge, they published, like you can use any 2 of the credit reporting, the credit bureaus. And so they looked at all the combinations, and so we took a look at the spread between the worst combination and the best combination. And the range is meaningful. You guys tell me what you think. FICO 10T spread between the best and the worst possible bi-merge pair averaged 9.2 points, with a 90th percentile to kind of tame the wild outliers of 18 points, 18-point spread. VantageScore was 6.19. So FICO 10T 9.12 between the best and the worst. VantageScore 6.19. Modest difference there. And the spread on at the 90th percentile for VantageScore was 14, again, compared to 18. So a little tighter numbers on VantageScore 4 there. But just to kind of give an idea, and that's why they're throwing this out here, is like, because this has taken a while, as we all know, to roll out all these 3 different initiatives. Which one should we go with? That's part of the point of this data as well, to help us all think about that.
That's interesting.
I find it fascinating that it really is, that compressed, right? I mean, I think if you would ask me this question, a year ago, I would have, thought that, 10T or Vantage would have had, double digit types of a differentiator, right? I mean, listen, 9 points certainly could be meaningful, no doubt about it. But in, the overall, spectrum of the things, like, I don't know that you're convincing me right now that this alternative solution that we're all having to go through pain and GSEs and lenders and the approvals, like, is is it really worth it? Especially if the costs aren't coming down, right? Like if the costs were coming down and we were making this an affordable consumer product, right? Because again, the consumers pays for all of this. We pass it through as lenders to our customer. Okay, well then I can probably get, you know, a more positive attitude towards it. But right now, higher cost, not a really meaningful differentiator like across the board. Like, why are we spending so much time and resource on this when there are so many other issues in housing that potentially could take our attention?
Fair question. And it's taken a long time to answer.
It's
We all know
it's
this
an
is,
it's an interesting topic because this touches the all the facets of the world we live in. On this subject, you have those who just want to originate loans. They just want volume. They want to close that loan. This is what they're driving. Then you've got the quants on the guys doing the analysis who are trying to figure out what our default rate is going to be if we make a certain amount of loans. And anybody can make any amount of money if you know what your default rate is. If you knew your default rate was going to be 10%, you could price for that. So all we're talking about here is predictability. How do you get a predictable home market where you know that your default rate is going to be this? Because now you can price for it. I can price for a 20% default rate, but it's going to be a huge number that I'm going to charge, right? So what we're talking about at the margins, we have these competing interests, originators versus the folks who might be more spreadsheet oriented and they don't want any defaults at all. You got this collision, and the ultimate answer, what's the value here? It's how predictable does it make default rates? And that's why I like the historical look back, Greg, is like, okay, so let's throw this data back a while
yeah.
and see what would have happened in the world had we had this. That's all we're trying to do here is predict default rates and,
I like
and originate home loans.
Mhm.
I like the consideration. I would have expected the spread between the buy merge to be much larger on the Vantage because as the younger modeling scale, I figured the FICO would be closer. But then it also makes me ask, and reviewing credit scores for borrowers on a regular basis, I'm always shocked at what shows up on one trade line, one reporting system versus another, right? TransUnion's always going to show you the cell phone charges before Experian does. They don't seem to care. And Equifax it's a crapshoot. You never know what's going to show up or not on that one. It's just really weird. And so while we're talking about FICO scoring and Vantage scoring, those are calculated models based on information. The farther up the stream, if you will, is really the three bureaus and how they report stuff. Because I honestly think that's where all of this falls from. We're just looking at the one thing we can all seem to control, which is who pulls the score, who's providing the score, instead of holding the three bureaus, which are driving costs, which is why Vantage isn't coming down, because what they're charging for these systems to pull the reports to give the score is driving the cost effectively. And it's like, I'm looking at the three datas. To Bob's point, I didn't sign a document when I was 5 telling them they could start pulling my social security number and start building a credit profile on me. I did not sign up for that until I was 16 and I went to Les Schwab to get my first set of tires with my dad co-signing to open a line of credit. That was the first time I signed that document, but by golly, I seem to have had a credit line already kind of established. They knew who I was. So it begs a deeper question. How in the world do you get the three bureaus to start doing something that's to the benefit of the consumer that they are arbitrarily rating and then charging to view the rate?
That is the golden ticket, the $1 million question. Any other fun
It's
thing?
a few more millions than just a million, I think. That that's why the lobbyists like to pay for that one.
Yeah.
Yeah. Well, one note to that effect, they did provide this data. The CRAs did, not the agencies published it. The GSEs published it, but it was the credit reporting agencies that actually provided the data. That's a little bit of effort they had to go to say what would all of these different statistics have been on each and every one of 53 million loans. I actually don't know the genesis of was that, who decided that should be done or that they would do that. Was it voluntary? Was there pressure from the administration? Somehow it happened, and it's a good thing. Transparency
That is good.
Wins the day for now, at least.
Yeah, I would agree that, the data, having the data now, or at least some semblance of data, is certainly a win. Understanding from a, consumer perspective, the cost involved. I mean, listen, at the end of the day, there's still three giants, right? And we're beholden to those three giants. The three giants are never going to, the likelihood of those three giants wanting to come together in some collective type of mind framing that is for the benefit of the consumer versus the benefit of their profit lines. I probably have a better shot, and anyone on this call knows I'm not even 5 foot and redheaded. I have a better shot of being a 6 foot blonde. Just saying.
I'm not much on conspiracy theories, but there are some things where I look at the disparate impact waiver, kind of the stuff we talked about earlier, Bob, 2 months ago, like some of the things that are happening, and the credit score changes and the modeling changes. And I'm like, there's a lot of breadcrumbs leading us a certain direction, isn't there? So something to consider. This podcast was developed with a major sense
you go
of,
into a stadium and it's all Pepsi or it's all Coke. They made a
oh, right.
decision. They signed a
Yep.
contract and they go, here, we're a Pepsi. All right. Why we have three without an absolute winner in this capitalist society in which we live is a little suspicious. We probably shouldn't have three. Somebody should have to step up and say, my Coke is better than your Pepsi, and we end up with a winner. But what we've got is not making anybody happy except maybe certain shareholders. We should have a winner. We should be a Pepsi stadium or a
Though,
Coke
there
stadium.
still is a choice, right? There still is a Pepsi and a Coke choice. The actual consumer of that, the stadium, has to make that. So I don't know if I'm going to get on the bandwagon with you to say that it should only be FICO, or I mean, pardon, it should only be Experian, it should only be Equifax, it should only be TransUnion. I think that there should be a choice. But to your point, I think that if you sign up and say TransUnion is where I believe that the best source of information, and I'm going to use them and them only, that should be an option. I totally agree there.
Yeah.
That would
Yeah,
be
Dr. Pepper's owned by nobody, but it sure is supported by Coke. And so I appreciate that as a Texan now. I claim it. It's been 5 years. Next month is 5 years in Texas, so I am full Texan at this
You
point.
heard it here.
That's it.
Yeah, I've got two cowboy hats and some chickens, so game on. Bob, as I was looking at this into Dana and Greg's point, and Ray, and in loving memory of him not being here just today. He hasn't passed
He's not
on,
dead.
but
He's
no,
just
he's
not
not.
here.
We started this podcast. The idea is take a concept. It's not no risk. It's not no, there's, you can and cannot do. So we're trying to talk about, and we do often, the stuff that's really in the gray. It's like, man, if you take that choice, what's your impact? What is the disparate impact of that decision? What is the impact long-term on the structure of our industry as a whole? That's why we have a data specialist, a BSA fraud specialist, a private money specialist, and somebody who just likes to read a lot of compliance law and make it sound good. That's me, by the way. And then the silver squirrel who shows up just to talk about compliance topics from a legal perspective. But it's like, this is the idea with a credit line and everything, is the data is going to tell a major story in another 18 months. We're going to see another cycle of lending. I know UWM's picking up the VantageScore, and a lot more brokers are pulling it because there is a concept there of it could be better. You've got larger lenders and backed by the MBA who are looking at this too, going, okay, what do we do with this? And then you see these look backs like that Greg's talking about. It's a great report. More of my conspiracy theory flag went off, Greg, when you said that the three of them actually brought the info together. That tells me they were already thinking about it and looking into it, because you don't pull that amount of data and then be like, oh, here's a report. Like, oh, they were already working on this.
Good point. But they're about to lose business when buy merge goes into effect, if you think about it. So that's
true.
There is some movement in the direction you called out, Bob, with Coke or Pepsi. It's at least one step in that direction.
Who's going to be the RC Cola? That's what we got to know. Who is the RC Cola? They're going to get left behind.
Do they still make RC Cola?
They do.
Me and my RC, right?
Hey, you know what I have on my patio right now to be iced is a case full of Fresca.
Yeah.
When was the last time you had a
Fresca's
Fresca?
delicious. Yeah,
Fresca
I love
is
Fresca.
delicious.
All right, y'all. Well, with that, go find a. I'll tell you where you get RC Cola in Texas is the mom and pop barbecue joints. When you walk into them, they've had the same RC Cola machine up since 1974, and they still serve it. It's crazy. I don't know how they do it, but that's where you're going to find it if you go in the South. Y'all, I appreciate having these
Y'all.
calls. Greg, thanks for pulling that data set up. Well, I'm looking forward to that. What I would say, have you guys done your blogs on this yet, Greg,
We
on
haven't
Polygon?
started writing about it yet. We're still digging a little bit deeper before we do
All right.
so.
Well, I'm going to plug you because Polygon Research with Greg and Lubomira, like if you haven't gotten on their website and looked at their blog, every week they're dropping insights and data stats on what's happening in our industry. And it's not all backwards looking HMDA stuff. Sometimes it's forward looking as well. And it's all projection structures that really have helped a ton. And from MLO Force's perspective, but also for Vetted VA, you guys give a great service. And so we're very grateful for that. So if you're listening to this and you haven't hopped on, go to polygonresearch.com and look at their blog and see some of those things. But with that, last thoughts, anybody? Bob, I'll start with you since you're the top of the square.
I'm good. Everybody have a great weekend.
I love it. Dana, Miss Dana, how you doing? Any last thoughts?
No, let's see who comes to the top, Coke or Pepsi.
I like it. All right, take us home, Greg. What else you got?
Competition, transparency, know your data. That's the
Know your
punchline
data.
for today.
Dude, I love it. And now I said at your square, and now I'm thinking of Hollywood Squares. So now I have to go watch an old TV show before I move on. So I'm gonna have to go YouTube that so I can get that on my head too. But you friends, have a great weekend. Ladies and gentlemen, thanks for tuning in again. And with that, we'll see you in the next episode. Take care.